Most people hear about interest rates on the news, glance at the number, and move on. But interest rates quietly shape almost every financial decision in your life. They decide how much your loans cost. They decide what your savings earn. They affect mortgages, credit cards, businesses, and entire economies. Understanding what an interest rate actually is, and why it changes, makes you a far smarter consumer of money. At its core, an interest rate is the price of money. When you borrow, the interest rate is what the lender charges you for using their money. When you save or invest, the interest rate is what someone pays you for letting them use yours. Money has a price, just like anything else, and that price is the interest rate behind every loan, deposit, or investment. This matters because the same dollar can behave very differently depending on whether it is earning interest or paying interest. A small change in the rate can quietly shift thousands of dollars over time. Many financial mistakes come from focusing only on the size of a loan or the size of a deposit, while ignoring the rate attached to it. The rate is often the real story. To understand how it really works, picture two main forces that decide rates. The first is supply and demand for money. The more eager lenders are, the lower rates tend to be. The more eager borrowers are, the higher rates tend to be. The second is risk. The higher the chance that a borrower might not repay, the higher the rate they're usually charged to compensate the lender for that risk. Let us look at a simple example. Imagine two people asking the same bank for a loan. One has a strong credit history, a stable job, and low existing debt. The other has missed payments in the past and unstable income. The bank will likely offer the first person a lower rate and the second person a higher one. Same product, same lender, but different prices based on perceived risk. A common mistake is to fixate on the monthly payment instead of the rate. Two loans for the same amount can have very different total costs depending on their rate and term. A small monthly payment with a long term and high rate can quietly become a financial trap. The rate, multiplied across time, is often where the true cost lives. Monthly comfort is not the same as long-term affordability. There is also a hidden risk in variable interest rates. Some loans start with a low introductory rate that can rise sharply later. People sign because the early payment looks affordable. They do not always read the fine print describing when and how the rate can change. When the rate adjusts, the payment can suddenly grow, and the borrower may find themselves in a very different financial situation than they expected. A useful way to picture interest rates is as gravity in finance. They affect everything around them, often without being seen. A small change in gravity would change how every object moves. A small change in interest rates changes how every loan, deposit, and investment behaves. Understanding that gravity does not require you to control it. It just means making decisions that fit the current environment, not ignore it. A second key idea is how central banks influence rates. In most countries, a central bank sets a key reference rate. That reference rate then influences what banks charge their customers and what they pay for deposits. When central banks raise rates, borrowing usually becomes more expensive across the system, and saving usually becomes slightly more attractive. When they lower rates, the reverse tends to happen. A practical example helps. Imagine a country where the central bank raises its key rate. Mortgages become more expensive. Credit card rates may climb. New car loans cost more. Savings accounts may slightly improve their offers. The same household, with the same income, suddenly experiences a different financial environment. Understanding this connection allows you to anticipate how your monthly bills could move over time. Beginners often misunderstand the difference between nominal and real interest rates. The nominal rate is the headline number written on the product. The real rate is what is left after you remove the effect of inflation. A savings account paying 3% feels good. But if inflation is 4%, your real rate is actually negative. You are earning less than the cost of living is rising in the background. There is also a psychology angle. People react emotionally to interest rate news, especially during periods of change. They may rush to lock in mortgages, switch accounts, or load up on debt before things shift. Some of these moves are reasonable. Others are impulsive. A calmer mindset is to understand the trend, evaluate your own situation, and make decisions based on long-term goals rather than short-term headlines. A simple practical rule helps you navigate any interest rate environment. Always read the rate before signing anything. Ask whether it is fixed or variable. Find out when and how it can change. Compare it to the inflation environment. Compare it across at least 2 or 3 providers. These small steps protect you across many years and many products, regardless of where rates happen to sit at any given moment. There are things to avoid. Do not assume rates will stay the same forever. Do not ignore the difference between nominal and real returns. Do not treat low introductory offers as permanent. Do not rush into major borrowing decisions just because rates feel low at the moment. And do not blindly trust marketing language about the friendliest possible rate without reading the conditions attached to it. A better habit is to think in scenarios when rates matter most. Ask yourself how your finances would look if rates rose by 1 or 2%. Ask how they would look if they fell. If a financial plan only works in a single rate environment, it is fragile. If it stays comfortable across a reasonable range, it is much stronger. Stress testing your plan against rate changes quietly protects your future. Over the long term, an understanding of interest rates changes how you handle every financial product in your life. You start choosing loans more carefully. You start moving idle savings into accounts with better real returns. You become less impressed by headline numbers and more focused on actual costs and gains. None of this requires you to predict rates. It only requires you to respect them as the quiet engine behind most of your financial life. So here is the short version. An interest rate is the price of money. It is influenced by supply and demand, by risk, and by central bank decisions. It can be fixed or variable. It can be quoted as nominal or real after inflation. Small rate differences become large over time. The same dollar behaves differently depending on the rate attached to it. The rate is always quietly part of the story. If you want to make stronger financial decisions, build the habit of always asking about the rate. Read it, compare it, translate it into doubling time and total cost. Ask what could make it change. The number itself is small. Its long-term influence is enormous. Once you treat the interest rate as the heart of every financial product, you will quietly start choosing better options across every part of your life.